Quick question for you. Can you beat S&P 500? Well, if you have some sense about financial markets and investing, you have heard that yes, 80 or 90% of professional money managers cannot beat S&P 500, and most of retail investors are actually losing money, let alone beating S&P 500 and so forth. And actually, that's probably true, and I kind of believe those statements. But here's the thing. Beating S&P 500 actually is extremely easy, and there is needed no effort whatsoever to do that. Simply increase your leverage. So for instance, if you are trading or investing with regular ETFs or I don't know, long-term future contracts, just buy leveraged ETFs or increase leverage for your S&P 500 indices, and you will beat S&P 500 for several multiples if you like to. Of course, one slight upshot of this fact is, or drawback, it will be better term, that you will have proportionately larger drawdowns as well. So if S&P 500 might have 40% drawdowns in severe bear markets, if you are having twice leverage, you might have 80 or 90% drawdowns, and you might get margin calls. So if you want to have those 20+% per year returns, remember that you have to have proportional drawdowns as well by very simple strategy. But in between of these two extremes, you might probably have, I don't know, utilize 1.2 or 1.3 leverage, so that in that case your drawdowns really will be higher than 50 or 60%, and your net increase in a year would be, instead of 10%, which is average historical increase of S&P 500, but something like 13% per year, and you could calculate the difference for next 10 years if you invest that way. So this is very simple idea how you could actually beat S&P 500. But here's the thing. Most retail investors and traders don't know that and don't know how to assess correct drawdowns for this idea. And most professional investors don't do that. They could do that, and it's very easy for professionals to understand it. They know it, that's why they are professionals. But their mandate states that they couldn't invest with more risk. Actually, if you look at mutual funds, mutual funds have strict risk and volatility criteria, and that means they will rarely go outside of regular risks of S&P 500 and general stock indices. So that means they don't care if they beat and don't beat S&P 500. What they care more is that their drawdowns and risks are not larger than general stock market indices. And that's why they are not beating stock market indices. Not because they can't, but because they don't have to, because that's not their objective. And if we talk about hedge fund world, well, where their problem or their issue is quite more interesting, because they also have a mandate as have mutual funds, but they usually have very specific investing strategies, and they are chasing risk-adjusted, not maximum return strategies for that specific investment area. For instance, they are investing in commodity markets. They are investing in specific stock sectors. Not, I almost told stock sectors, not stock sectors. Do not confuse this. But anyways, you get an idea. And they might have long short market neutral strategies when they are at the same time going at long, or simply saying they are betting on stock market rise and they are at the same time betting at stock market fall. So this is what this is macro neutral strategies. And they also have an objective to gain 5 to 10% per year, but trick is to have very small corrections of their equities so they don't lose that much money, because most of their investors are professionals or institutions which don't care that much about very high returns than of consistency. And I would bet that any decent hedge fund trader or manager could make strategy that makes 200% per year easily. It's not profitable for them to do that. It might make sense for people who have small capital and who don't make that much money out of huge profit commissions which typical institutions receive. So here we are going to the realm of individual traders and investors. And here also, it's not that difficult to create strategy which actually beats the market, because if you are now looking at the realm of professional investing from retail investors standpoint, as I told you before, if you are increased slightly leverage of your initial investing positions, you might have proportionately higher returns and slightly higher risks. And if you have, like, instead of worst case scenario, not 40 but 55% drawdown, you can tolerate that. Maybe you can, maybe you cannot, but it's entirely possible to build that strategy without having any kind of sophistication. Where you should and need to have sophistication if you invest outside of regular S&P 500. And their history shows us that dividend investing might have risk-adjusted return which is slightly higher or same as S&P 500, but that's a different strategy. It's not tended to have higher returns, it's tended to be more stable. Then you could actually go for small caps, and especially small cap stocks which follows technology sector. There historically have been 2 to 3% higher returns with slightly proportionately higher risks. So in that means you are effectively using strategy when you are proportionately making more money when stock market rises, and you are proportionately losing slightly higher if stock market fails. But in general, if we have secular bull market, you will make more money with this passive investing strategy. Other kind of strategies which might make money, for instance, is famous William O'Neill canceling strategy, where you simply are investing into strongest companies at that particular point when they had made the strongest returns. It might sound silly from the start, but there is historical pattern in markets that when markets are strong, they continue to get strong. For instance, in previous years we had strong, magnificent 7 technology companies, and if we invested in only these 7 companies, we might get way higher returns than in any other sector or in most of the S&P 500 stocks. So idea is that we are following simply to those strongest companies, and if we are saying that they are continued to rise in share prices and their fundamentals improve, and it doesn't matter if you have price to earnings or price to book valuations which seems really high compared to S&P 500, we are just simply chasing momentum. And funny enough, this strategy has been beating markets for decades. It's slightly tricky to implement it, but it works. And there are also a few other strategies which might significantly beat S&P 500. And you could see in small investing communities, in small groups where people are gathering and sharing their investing ideas, that they are beating market for decades. But the difference is that you don't see them because firstly they don't have institutional capital and they are investing on their own, and probably they will have few $100,000 at best. But in overall, in higher terms, yes, of course there is huge element of luck, but it's not actually that difficult to create strategy which is better than S&P 500. You could even stack your strategy yourself if you have strict criteria how to use them and how to evaluate them. And this is nothing new. You don't need to have AI for that, because you could do that previously with the elementary stock screeners which you could get for free. You simply have to see what are the strongest companies with relatively good valuations, and as always a little bit of luck, and you probably could get decent portfolios. Trick is that most people don't understand this, and most people don't have temperament to fully implement these strategies and understand how to evaluate them against ETFs and general stock investing benchmarks. And that's the problem. Usually people either are investing S&P 500 and forgetting about it. That's not actually the worst thing to do, but if they are creating their own strategies, they don't have a clue how to value this strategy against S&P 500, how to actually find companies or funds which has decent chance of beating the markets, and how they actually stack this all up together. So if you have these criteria, it's not that difficult to beat the market. But remember, you are talking about 10,000 euro or dollar investment. You're not talking about 5 billion hedge fund. And that's the reason you should never ever compare yourself to professional managers, because professional managers firstly can beat S&P 500, but they won't do it because they maybe have too large funds that they are not using these strategies that you can use, and secondly, they don't have to do this because they are making profit fees and commissions which would make more than enough for them, so they don't have any interest to do that. So if someone says it's extremely difficult to beat S&P 500. Yes, it is, because most people don't know how to invest, and secondly, professionals don't beat indices because they don't need to do that, because they have different business models. So see for yourself. There is enough evidence that you could do it, but you have to be professional. Yes, you have to understand fundamentals, you have to understand financial statements, you have to understand company valuations, you have to understand stock market valuations. If you do that, you might have a chance, and you probably need to have decent chunk of capital to make it worthwhile, because if you try to beat S&P 500 with 100 euros within your account, there is actually no good use for that. It will be way better for you if you simply have 4 or 5 ETFs which you would follow, invest all those 100 or 200 euros per month and simply compound your capital. If you have like 100,000 plus, and you could be able to invest 50 to 100,000 each year, then there you might have some purpose for that, and you actually might make something out of it. If you can't, the easiest way for you to make money and accumulate your wealth. Simple as that.